Welcome back to the Empowerment Library. In our last episode, we explored Darren Hardy's The Compound Effect, a book about how small choices create massive success. Today, we're diving into Peter Lynch's classic One Up on Wall Street, where he reveals how ordinary people can achieve extraordinary returns in the stock market. His advice is simple yet powerful. Pay attention to the companies and products you already know, and you can often spot great investments before Wall Street does. This book is packed with practical wisdom and shows how common sense can turn into financial growth. So let's dive in and learn how to invest with confidence.
Part 1: Preparing to Invest. In this opening section, Lynch focuses on mindset and preparation. He explains that ordinary investors often have advantages over professionals because they notice products, services, and trends in their daily lives before Wall Street analysts catch on. Instead of fearing the market, Lynch encourages readers to see it as a place full of opportunities. He stresses that you don't need to be a genius or have inside connections. You just need patience, discipline, and common sense. By paying attention to the businesses around you, you can identify strong companies early. This section also debunks myths about investing and sets the stage for why the stock market is one of the best tools for building long-term wealth. Lynch's message is empowering. With curiosity and observation, anyone can become a successful investor.
Chapter 1: The Advantages of Dumb Money. Lynch begins by explaining why individual investors often have advantages over professionals. Fund managers face restrictions, performance pressure, and layers of bureaucracy, while ordinary people can move faster, choose freely, and act on what they know. He argues that small investors can spot opportunities earlier by paying attention to local businesses, shopping trends, or industries they're personally familiar with. Lynch points out that professional money managers often underperform the market because they're forced into short-term thinking. Meanwhile, individual investors can be patient and long-term oriented. He calls this the dumb money advantage. Ordinary investors are free to invest in what they truly believe in, without institutional limitations. This chapter is meant to encourage readers that they don't need Wall Street expertise to succeed.
Chapter 2: The Wall Street Oxymorons. Here Lynch pokes fun at Wall Street jargon and the contradictions in professional investing. He highlights how experts often make predictions that turn out wrong, and how market forecasts are unreliable. For example, terms like blue chip or growth stock are often used loosely without clear definitions. Lynch insists that you don't need to understand every fancy Wall Street term to be a great investor. Instead, focus on the basics. Know what the company does, how it makes money, and whether it has room to grow. The chapter emphasizes common sense over technical jargon. Lynch reassures readers that confusing language shouldn't scare them away. Investing is about businesses, not buzzwords.
Chapter 3: Is this gambling or what? In this chapter, Lynch tackles the fear that investing in stocks is just gambling. He explains that gambling is about luck and chance, but investing is about owning pieces of real businesses that produce goods and services. Unlike a casino, where the odds are stacked against you, the stock market grows over time because companies innovate, expand, and generate profits. He emphasizes that patience, research, and discipline transform investing into wealth creation. Short-term trading may resemble gambling, but long-term investing is grounded in economic growth. Lynch encourages readers to shift their perspective. Buying stock is buying into a company's future. When you understand the business and hold on long enough, you're not gambling, you're partnering in success.
Chapter 4: Passing the Mirror Test. Lynch stresses the importance of self-awareness before investing. He calls this the mirror test. Look in the mirror and ask yourself what kind of investor you are. Are you willing to put in the time to research? Do you have the patience to ride out market swings? Can you handle temporary losses without panicking? If not, you may be better off in index funds. The key is honesty. You must align your strategy with your temperament. Lynch believes everyone can succeed, but not everyone is suited for individual stock picking. This chapter highlights that self-knowledge is as important as financial knowledge. Successful investing requires discipline, patience, and a realistic understanding of your own strengths and weaknesses.
Chapter 5. Is this a good market?
Please don't ask.
Lynch argues against trying to predict whether the stock market is good or bad at any given moment. He explains that market timing, jumping in and out, is nearly impossible, even for professionals. Instead, the focus should be on finding good companies and holding them long-term. Over the years, the market has always risen despite countless crashes, recessions, and scares. Lynch points out that waiting for the perfect time usually means missing out on growth. The best strategy is to stay invested and let compounding do the work. He emphasizes that great companies can be found in any market condition, so investors should concentrate on research rather than predictions. The lesson: it's not about timing the market, it's about time in the market.
Part 2: Picking Winners. Here Lynch dives into his investment strategy and how to spot great stocks. He introduces his famous 6 categories of stocks: slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays. Each type has its own opportunities and risks, and knowing the difference is key to smart investing. He explains how to read financial reports, understand earnings, and judge whether a company's story makes sense. Lynch stresses the importance of doing your homework, researching businesses you already know and use, rather than chasing Wall Street fads. He provides practical checklists of what to look for in a winning company, from strong balance sheets to growth potential. This section is packed with case studies of companies he invested in, showing how everyday observations can lead to big profits. The core lesson: invest in what you understand and back it up with research.
Chapter 6. Stalking the Tenbagger. Here Lynch introduces one of his most famous concepts, the Tenbagger, a stock that increases tenfold in value. He explains that finding just 1 or 2 Tenbaggers can transform your portfolio, and ordinary investors have the advantage of spotting them early. These are usually smaller, lesser-known companies with strong growth potential. Lynch insists that patience is critical. Tenbaggers often take years to mature. He also reminds readers that big winners are usually found in everyday life, like a store you love, a product that's gaining popularity, or a service that solves a common problem. The secret is paying attention to what's around you and recognizing opportunities before Wall Street does.
Chapter 7. I've got it. I've got it. What is it? In this chapter, Lynch emphasizes the importance of truly understanding the businesses you invest in. Buying a stock without knowing what the company does is a recipe for disaster. He suggests that you should be able to explain the company in simple terms to a child or a friend. If you can't, you probably shouldn't own it. Lynch warns against chasing hot tips or blindly following trends, since those usually end in disappointment. Instead, focus on companies whose products, services, and industries you actually know. The clearer the story, the easier it is to judge whether the stock has potential. This chapter reinforces his philosophy of investing only in what you understand.
Chapter 8. The Perfect Stock, What a Deal! Lynch describes the traits of an ideal stock. A perfect candidate might be a company that's boring, overlooked, or operating in an unglamorous industry, because those stocks are often undervalued. He also likes companies that are simple to understand, have room to grow, and are leaders in their niche. Other positive signs include insider ownership, executives holding large stakes, low debt, and consistent profitability. Lynch points out that sometimes the best investments are the ones nobody is talking about, since Wall Street tends to ignore them until they've already risen. The chapter encourages readers to look beyond flashy companies and seek out hidden gems with strong fundamentals.
Chapter 9. Stocks I'd avoid. Just as important as knowing what to buy is knowing what to avoid. Lynch lists several red flags. Companies in hot industries that everyone is rushing into, firms with overly complex businesses, or companies that depend heavily on a single product or government regulation. He also cautions against chasing turnarounds that rarely succeed, and businesses with high debt or weak cash flow. Lynch stresses skepticism toward companies that sound too good to be true. If a stock has a complicated story or seems to promise endless growth without risk, it's usually dangerous. This chapter teaches investors to stay cautious, and avoid getting burned by hype or unrealistic expectations.
Chapter 10, Earnings, Earnings, Earnings. This chapter highlights the central importance of earnings growth. Lynch explains that stock prices ultimately follow earnings, and a company that consistently grows profits will reward shareholders. He encourages investors to study earnings reports and focus on long-term trends, not just short-term fluctuations. A strong company should have steady, predictable earnings growth, supported by real sales and demand. Lynch also points out that Wall Street often overreacts to temporary earnings dips, which can create buying opportunities. The main takeaway: a company's story must be supported by growing earnings, because that's the engine that drives stock prices higher.
Chapter 11, The 2-Minute Drill. Lynch introduces the idea of the 2-minute drill, a quick, simple way to explain why you own a stock. If you can't summarize the business, its strengths, and its growth prospects in a couple of minutes, you probably don't understand it well enough. This drill forces investors to focus on the essentials. What does the company do? How does it make money? What's its growth potential? What could go wrong? Lynch believes this kind of clarity helps investors stay disciplined, especially during market downturns. The 2-minute drill becomes a mental checklist to ensure you're not investing blindly.
Chapter 12, Getting the Facts. Here Lynch stresses the importance of doing your own research. He advises investors to dig into annual reports, financial statements, and industry trends. While Wall Street analysts may provide information, individual investors should verify facts independently. Lynch encourages readers to pay attention to everyday experiences, like which restaurants are always packed or which stores are expanding rapidly. Combining personal observation with financial data gives a more complete picture of a company. He warns against relying solely on headlines or rumors, since those can be misleading. This chapter emphasizes curiosity, legwork, and combining common sense with numbers.
Chapter 13, Some Famous Numbers. Lynch explains the key financial metrics every investor should know. The price to earnings, P/E ratio, the price/earnings to growth, PEG ratio, debt levels, and dividend yields. He breaks these concepts down in plain language, showing how they can be used to judge whether a stock is overvalued or undervalued. For example, a high P/E ratio may be fine for a fast-growing company, but risky for a slow grower. The PEG ratio helps balance price with growth expectations. Debt levels reveal how financially stable a company is. Lynch emphasizes that numbers should always be viewed in context, compared with industry averages and the company's history. These famous numbers help investors separate bargains from overhyped stocks.
Chapter 14, Rechecking the Story. This chapter focuses on monitoring investments after you've bought them. A company's story can change, and what once looked promising may no longer hold true. Lynch advises keeping up with news, earnings reports, and industry developments to make sure the original thesis still applies. If the fundamentals deteriorate, slowing growth, rising debt, declining sales, it may be time to sell. But if the story remains strong, temporary price drops can be opportunities to buy more. Rechecking the story keeps investors from holding on blindly or panicking unnecessarily. It's about staying engaged and adjusting when the facts change.
Chapter 15, The Final Checklist. Before committing to a stock, Lynch suggests running it through a final checklist. Questions include: do I understand the business? Does it have growth potential? Is it financially healthy? Who are its competitors? What risks could derail it? Does management own shares? Is the valuation reasonable compared to earnings and growth? This checklist is meant to bring discipline and prevent emotional or impulsive decisions. Lynch stresses that successful investing is not about finding hundreds of great stocks, but a few good ones you can hold for the long term. Careful screening upfront saves pain later.
Part 3, The Long-Term View. The final section is about staying patient and disciplined once you've invested. Lynch argues that the real secret to wealth is holding on long enough to let compounding do its work. He warns against panic selling during downturns and emphasizes that market swings are normal. Instead of trying to time the market, investors should focus on time in the market. He also explains when it makes sense to sell, such as when the company's fundamentals change or the growth story no longer holds. Lynch reinforces that successful investing is about consistency, patience, and staying rational when others are fearful. He concludes with the reminder that ordinary people can outperform the experts if they stick to what they know, stay disciplined, and think long-term. This section ties the book together as a blueprint for lifelong investing success.
Chapter 16, Designing a Portfolio. Lynch explains how to build a portfolio based on your risk tolerance, time horizon, and the types of stocks you own. He advises diversification but not over-diversification. Owning 10 to 30 well-researched stocks is usually enough. Too many stocks can dilute returns and make it harder to track them. Lynch also suggests balancing different stock categories. Stalwarts for stability, fast growers for big potential, cyclicals for opportunistic gains, and turnarounds or asset plays for added diversity. The goal is not just to own many companies but to own the right mix. A portfolio should reflect your personal knowledge and investment style, rather than copying others.
Chapter 17, The Best Time to Buy and Sell. This chapter addresses timing, but not in the sense of predicting the market. Lynch argues that the best time to buy is when you've identified a strong company at a fair price, regardless of market conditions. He warns against waiting for the perfect moment, since it rarely comes. On selling, he stresses that you should sell only if the company's fundamentals deteriorate, the growth story breaks down, or you found a better opportunity. Price fluctuations alone are not a reason to sell. Lynch believes patience is key. Most investors sell too soon and miss the big gains. His mantra is, let your winners run, and cut your losers.
Chapter 18, The 12 Silliest and Most Dangerous Things People Say About Stock Prices. Lynch lists common myths and excuses investors use, such as, if it's gone this high, it can't go higher, or if it's dropped this much, it can't go lower. He calls these dangerous because they rely on emotions instead of logic. Other examples include, it's only $3 a share, so how much can I lose? Or, I'll sell after it bounces back. Lynch dismantles these flawed ideas, showing that stock prices follow business fundamentals, not wishful thinking. He emphasizes rational analysis over emotional shortcuts. This chapter reminds readers to avoid herd mentality and focus on facts, not feelings, when making investment decisions.
Chapter 19, Options, Futures and Shorts. Lynch gives his perspective on more advanced trading tools. He is skeptical of options, futures and short selling for ordinary investors, arguing that they are risky, complex, and often unnecessary. While professionals may use them effectively, most individuals end up losing money. Lynch believes long-term investing in strong companies is far more reliable. He emphasizes that compounding returns in stocks is a simple, proven method of building wealth, while derivatives and speculation often lead to overconfidence and mistakes. His advice is straightforward: stick to stocks you understand and avoid unnecessary risks.
Chapter 20, The 20th Century's Greatest Stockpicker. In the closing chapter, Lynch reflects on investing as a lifelong journey. He highlights stories of ordinary investors who became wealthy by applying common sense, patience, and discipline, not by being geniuses or having inside knowledge. He reinforces that individuals can outperform professionals by using their everyday observations and sticking to businesses they understand. Lynch also shares lessons from his own career, reminding readers that mistakes are inevitable, but learning from them is key. He ends the book on an empowering note. Successful investing isn't about luck or complexity. It's about consistency, curiosity, and a long-term mindset.
That wraps up our dive into One Up on Wall Street. Thank you for watching the Empowerment Library. Don't forget to like, subscribe, and share for more empowering book summaries. Next time, we'll explore Brian Tracy's Eat That Frog, a practical guide to beating procrastination and boosting productivity.